Thank you to today's sponsor, Meet Kevin. Kevin's courses on real estate, the stock market, sales, and YouTube are extremely helpful and teach you everything you need to know. They are jam-packed with useful information, and he teaches you what to look for, what to avoid, and everything in between. His courses all come with access to his daily live stream. During these live streams, Kevin reveals his daily stock picks and does personalized real estate deal analysis. And he'll even review your YouTube channel. Check out the link in the description and use code TOTHEMOON for 39% off your course. Kevin's courses go up in price over time, and that coupon code expires tomorrow, May 5th, so make sure you act now to get the best price.
Here's the problem, and it's trying to determine where to put your money right now, which is virtually impossible, because everything you might choose to protect against one thing may be affected by another. And so let me give you an example. So in a normal environment, when you're nervous about markets, you go into bonds. Okay, so if you don't like equities, you buy bonds. Why would you buy bonds today? I mean, they're yielding nothing in a zero rate environment where money's being printed like crazy, which is destroying the value of the nominal value of that bond. So, in currencies where where the central banks are printing loads of new money, so buying bonds doesn't make sense. You want to be in cash, it's going to be destroyed by inflation. So you buy equities. Yes, you can buy equities and you'll not lose all your money, but you might be buying at the wrong time at the top of a very, very frothy market, incredibly frothy market that is due for some sort of a correction, which will be caused by some event yet unknown. We had COVID last year, and who knows what the next catalyst is going to be for the next market downturn. It needs an excuse to correct, and it will. And the next one could be very similar to the COVID one. It could be some unknown event having to do that might trigger a financial crisis or some sort of other move. So I just, it's hard to choose investment categories right now, and that's why I'm taking a general macro view that we're in a hard asset environment. So the best protection you're going to get, it's not going to give you 100% protection because anything can happen. But with the money printing and the amount of debt that's being issued, I would be skewed towards hard assets. And hard assets are obviously include gold, real estate, art, and some people believe Bitcoin. I'm not sure that I believe that yet, and I can certainly explain my reasons why. But some people seem to believe that that's a similar hard asset that's similar to gold.
If this money is manifesting, this money that was created is manifesting itself in the form of higher asset prices, what's to say, what stops those higher asset prices? For example, Kathy Wood suggests, hey, well, usually we value the S&P at 20, maybe 18 times earnings. Who's to say S&P shouldn't be valued at 40 times earnings? Maybe people need to have lower expectations and they should expect a 3% return on their money instead of a 5 or 6% return on their money. Valuations go up, return expectations go down. No necessary bubble. What's your response to that?
Yeah, my response is you can play that game for a while, but eventually you come back to reality. I mean, when you buy equities, you're buying, the discounted future cash flows of that business. And then you apply a multiple to it, and that's how you establish market.
Right.
If you're pushing out that that discounted cash flow forever, and it's like, where's the value in that business? I mean, at the end of the day, what is that equity worth when you've already discounted all its cash flow?
Sure.
Now your rates are at zero. You have no further way to go down to create a higher valuation. I just don't buy that, and I don't buy that this time it's different, and that's what makes me insane. I remember the 1999 dot-com bubble, and I remember reading research reports by analysts that were making these crazy projections about these worthless stocks, and they had to come up with even more and more outrageous reasons why these stocks were valued at ridiculous prices, and they kept. I remember being at a dinner party with some dot-commers that were invested in the dot-com market, and I just made a question. I said, I can't get my head around these valuations. I don't know how it works. Man, they came all over me. It was like I was a dinosaur. I didn't understand. This time was different. The world was changing, whatever. It never changes. Bubbles are bubbles. they burst, they need an excuse to burst, and then all of that debt that is used to create that bubble comes cascading down and wipes everybody out, and then you start over again. So that's where I think we're headed.
Wow.
I can't give you timing on it. This market could go a lot higher. These equity, we broke all records. S&P at 4,000. I mean, sure, it could go higher, but remember, the higher it goes, when it does crash, it's going to really, really be significant, because the higher lower it goes. And so, again, I don't know what the answer is. I'm not sure. I'm having trouble myself trying to determine where to put my money. But this is definitely bubble territory, and it's going to end somehow, sometime. It just needs a catalyst to make it happen.
Ray Dalio, if you don't mind, Ray Dalio believes that we might enter a period of the great deleveraging. Something that I've noticed over the past, I don't want to ask you about that, but something I've noticed over the past few months is a slowing down in the growth of brokerage margin. People are taking less margin on over the last few months than they had been, during the 6 months prior. Do you think it's possible that we could go into a period of hedge funds saying, you know what, let's borrow less, especially after the Archegos fallout? Maybe individuals start saying, maybe I don't want margin. Maybe it is time to deleverage. And then maybe Ray Dalio's predictions come true that we do go through a great deleveraging. What's your take on that possibly?
Well, I think we are, and I love listening to Ray Dalio. I think he's got his head screwed on right in terms of looking at it from a historical perspective, and it's the same thing I've been doing for 20 years. He's much more famous than I am, but I've been writing about the same things that Ray is talking about. I've been writing about for a long time. He talks about several things, and the long-term debt cycle is one of the most important features that no one understands, because they happen every 70 years or so. So our generation didn't go through the 1930s depression and the stock market crashes and all of what came with it. So we forget that those things do happen. So you have these long-term debt cycles that grow exponentially near the end, because people think, well, this is great. Nothing can go wrong.
Right.
It's this time is different. And it's worked for the last 10 years, and I've only been doing this for 10 years or 20 years. So if it's worked for the last 20 years, it's going to work forever. And what Ray Dalio rightly points out is that, we're about to experience one of these paradigm shifts where, you get accustomed to certain type of performance, you get very confident, things get very popular, everybody starts to borrow money, and prices go higher and higher. And every 10 years or so, you get one of these paradigm shifts, and we're really due for the next one now. And again, it lasts a few more years or whatever, but we're due for the shift where everything's too easy. It's so easy to make money, right? I mean, it's like you can buy, you have all these Robinhood traders, buying Gateway. Everybody's having a ball, and everything seems easy. And when it ends, everybody's levered up to the hilt, and a lot of people are going to get hurt.
Shout out to the sponsor for this video. The program's linked down below from Meet Kevin. Use that expiring coupon code linked down below to learn how to go from zero to millionaire in real estate, and also check out the programs on YouTube, sales, and stocks.